Hello and welcome to the Insight is Capital podcast. I'm Pierre Daillie, managing editor of advisoranalyst.com. Joining me are my special guests, Ben Gossack, Vice President, Director and Portfolio Manager, and Trevor Cummings, Vice President of ETF Distribution, both from TD Asset Management. Today, we're going to be talking about how investors are between a rock and a hard place, looking for innovative ways to achieve attractive income streams without sacrificing total return or reaching for yield.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Ben, Trevor, welcome to the show. It's great to have you.
Great. Thanks for having us.
Great to be here.
I thought maybe we'd start off by talking about some of the innovative things that you're doing at TD Asset Management, what you're seeing, some of the trends you're seeing in the market, what you're seeing investors do from your perch in terms of ways investors are trying to find new ways as opposed to sticking to the old sort of traditional ways of finding yield in this market. Maybe you guys can take turns talking about some of those things.
Trevor, maybe I'll just start off with the problems that we're seeing, and then maybe you can talk about sort of the products that people have been seeking out and try to solve their income needs. I'd say, Pierre, even coming out of the great financial crisis, we were in a pretty low interest rate world. And I'd say your average investor is probably in a 60-40 portfolio. So 60% equities, 40% fixed income. And even, we think, we had low rates then, we have even low rates now, but that portfolio was probably yielding about 2.5%. Now the average inflation was about 2.5. But I'd say most people didn't really see the bite, when it came to consuming goods and services. And what's happened with COVID is the central banks and governments had to take such extraordinary measures in order to sort of bridge this, our economy to the other side of this healthcare crisis. And that meant lowering interest rates. And so that 2.5 portfolio that, many investors were already complaining was too low, is probably yielding about 1.5% now. And now the inflation that was around 2.5 is coming out around 4 to 5. And people are really starting to see it. And they're seeing it in, when they're trying to buy a car. They're definitely seeing it in house prices, at the grocery store. So now they really feel it, and they really feel that sort of that 1.5% yield. And I think that, fuels even more pressure. I kind of look at it this way. If I was earning 2.5 and now I'm down to 1.5, overnight, I got to double my nest egg.
That's
or
right.
I need to find stuff that, generates a lot of yield. And in many cases, you definitely will move yourself up the risk curve if you're trying to find, assets that throw off a lot of yield, because as all things, nothing comes for free. So I'd say that I think that generally sort of lays out the challenges that savers are facing right now, on this side of the COVID crisis.
Yeah, I mean, it's huge when you think about it. I mean, if you have $1 million, $1 million isn't what it used to be. At 2.5%, that's a $25,000 income. And then if suddenly, you're looking at 1.5%, that drops to 15,000. Given that you would want to have something similar, you would have to have close to $2 million in order to get that $25,000 to $30,000 equivalent. And then again, I mean, what kind of retirement are we talking about with $25,000? So it's extremely challenging. I mean, in terms of what the liabilities are, what the requirements are for anyone facing retirement in 5, 10, 15, 20 years, whatever the outlook is for any given investor. The goalposts have been moved quite far away just by the Fed and by the intervention in the economy.
I think,
So,
you could say the 4% rule is dead, right? William Bengen, a quarter century ago, did this study and said, you should be able to take out 4% of your portfolio, adjust it for inflation every year, and 99 times in 100, you'll never run out of money subject to some tail risk. Those days are gone. I think there's been this secular shift towards investing for yield with the rise of fee-based and discretionary asset management. So just within the industry, there's more appetite for yield so that the financial professional, the investment professional, can take their fee without touching the principal of an account. There's demographics at play. Certainly, we're not getting any younger on the panel today, but that's Canada at large. StatsCan says there's more Canadians 65 plus than 0 to 14. There's more seniors in Canada than children, and we're never going back. So more and more people are looking for yields, and there just isn't any out there unless you stretch. When you look at, say, just passive vanilla indexes, the emerging markets index pays a higher yield than the TSX at this point. And even still, it's about 2 3/4 versus about 2.5 right now. So neither of those are going to get anybody close to the 4%. Now, there are some indexes out there that do yield 4, but you're talking EM currencies, you're talking global high yield bonds. You've really got to take on sort of a non-commensurate amount of risk in order to earn that kind of yield. So investors need to do more than just pursue, asset classes with higher published yields. They're going to need to do something else, whether that's innovation, whether there's some activity within the portfolio, but just, picking and choosing asset classes and then adjusting your withdrawal rate for inflation. That's not going to work any longer.
It's funny, while you were talking, Trevor, I was just thinking of the lifestyle creep. The simple answer is, what's the solution to this? Well, we're going to have to make more money, right? But it's not that simple. I mean, investors are doing a lot of crazy things, in this market, and some of it is because of this idea that there's no alternative, or TINA. But so from your guys' perch, from where you sit, you're probably receiving a lot of internal research from within, TD's internal findings and research from market research within the firm. What is it telling you that investors are doing? What are some of the crazy things that you think are crazy that investors are doing in order to satisfy this liability of 4% plus in order to get more income from their assets? And what are some of these? What are some of the things also? Let's also pad that with what are the things that investors aren't doing?
So, I mean, I'll take that one first, I guess. When you think of things in the context of exchange traded funds, outside of the passive, plain vanilla benchmarks, one of the biggest categories out there is the dividend ETF. And, a lot of them, I'd say most all of the dividend ETF universe, one of the very first things they do in that kind of funnel where they're taking many securities to few is they screen for yield. So, take 100 names in a geography or in an asset category, sort them from highest dividend to lowest dividend, and, knock out the bottom half and don't give them a second thought. And the trouble really is that there are some really incredible opportunities in the bottom half of that list. If you're led by the nose to what the dividend yield is, the first problem is you might be missing out on really great opportunities. The flip side of that coin, though, is the top half of that list might be the riskier half. I mean, you never know for sure, but certainly some of the names with high yields have high yields to reflect the risk inherent in those specific companies. $100 stock with a $3 dividend is a very, basic 3% yield. Well, if that stock falls over the next 12 or 15 months to $50 a share, the yield is going to show 6% on that security. And if I don't do any due diligence, if I just sort of call it a day and blind faith invest, well, I've invested in something that, hopefully will stop declining in value. Who's to say?
Right.
But I'm fooled almost really by this illusory 6% yield when in fact that company might be in such meaningful distress that dividend itself is at risk. So you can't just screen for yield. And I know a lot of the dividend ETFs are going to do a little bit more. They're going to look at the track record of that company. They might look at some quant metrics. But again, the first point stands. There are some really, really great opportunities in the market out there that maybe only have a yield of 1%, maybe have a yield of less than 1%, maybe have a yield of 0. And so I think it's important to be more holistic in sort of interpreting, where the opportunities are to start.
Pierre, I'd say, again, anecdotally, I mean, you hear stories about people doing private lending or private mortgages. I mean, depending on the sophistication of investors, people might go out there and take on all that risk. Or now we're hearing stories about decentralized finance that, again, people don't get anything on their money market and moving into, again, some of these esoteric areas. I'd say, kind of picking up from Trevor in sort of the traditional, let's say the ETF or mutual fund space, you either are chasing the high dividend yielders, and that will be sort of your telcos or utilities or some of your staples. But from a fundamental perspective, they might be facing, negative earnings growth. And then the challenge, I think, for people that were going after the blue chips, is that their stocks have, their companies have actually done quite well because of COVID, and they've seen revenue growth and margin growth, and we're seeing record free cash flow growth. And that's being reflected in the price. And in many ways, the dividends haven't kept up. So the dividend yields that are out there are quite small. So that is challenging, I'd say, for anyone right now to sort of, where they were going, in the traditional. I'd say what people are not doing, to pick up on the other part of your question.
Right.
Whenever we find people chasing income, they never look at their total return. So I call it like the used car lot sticker. It's just look at the big sign that says 6%, 8% yield. Only focus on that.
Yeah.
Don't look at the rest of the car. Just focus on that sticker. And that'll be great because people are like, well, it's like a 6% return. That's my yield. And they don't, your real returns are a combination of the price of the security and the dividends. And what ends up happening is sometimes the price overwhelms. So the stock could be down 20%. Doesn't matter that you got that 6% yield. You're actually falling behind.
Yeah.
And again, the fact that people aren't looking at total return, we talked about, in some cases you need to double your nest egg overnight. Well, if, you invested in these securities thinking that you were getting income, but your capital is actually depleting on you, your hurdle to even get back to where you were just, becomes, it's, as they say, in The Simpsons, we got to dig our way out of the problem. You just kind of keep going lower and lower. So I'd say from my perspective, I think Trevor would share that the biggest thing that we find that people miss, when they're looking out for income is they forget about price, and they become maximalists. And in that situation, it can work out, but most of the time, it typically leads to capital losses.
It's like the fuel economy and the maintenance costs of a car versus the windshield price. Yeah, indeed. You've got to do more due diligence than just the surface. I think one of the other siren songs really in the ETF space in particular is the $20 billion worth of systematic covered call or buy right ETFs. And, they all kind of have really generous yields, but they do indeed come at the cost of price return. On a total return basis, very, very few of them beat a fairly standard buy and hold strategy of the asset class or the category. So I think those are kind of those real observations really of the siren song of dividends and really the even, amped up yields that you can find in covered call ETFs led us to thinking about, what can we do here at TD Asset Management in the ETF space that takes elements of that, delivers some yield improvement, but also delivers additional total return to investors.
There's 30 or 40 years of recency, of 60-40 working and continuing to work. And so the drive or the impetus to change away or to do things differently away from the 60-40 model that has worked for so long and that people have gotten very comfortable with, maybe is the better way to put it, is that it has left investors with sort of a knowledge gap. I always go back to this idea of known knowns, known unknowns, and unknown unknowns. And I'm hoping that by the end of this conversation, that we'll get into some of the known unknowns and some of the unknown unknowns even. I think part of the problem is that investors and advisors alike, for that matter, don't necessarily know what's possible out there in the marketplace. There are things that are available today that weren't available, 2, 3, 5 years ago. So let's talk about what you guys, your research uncovered that bridges the gap between the two areas of total return and income, because most of the strategies that are in the marketplace right now only do half or one of those two strategies, but very few or rarely do they do both. And this was really a gap that you worked to fill. So maybe talk about some of the things that you discovered in the marketplace or solutions that you innovated that address that.
Sure. So I'll give you some of the history of the product, and the genesis sort of goes back even to 2016. Our industry is quite competitive, and I think Trevor was saying that covered call strategies are 20 billion to 30 billion in assets under management, but they've been gathering assets for quite a few many years. So at that time, TD Asset Management didn't have ETFs, but we have a great dividend growth franchise. And the ask was, what's going on in the option market and how do we participate? And so, we looked at it from the call side. So that's basically giving up appreciation for income today, because that's where most of the assets that we could see that were gathered. Those were the funds that were gathering the most assets, and they were all typically systematic. Many of them are sort of sector focused or equal weight, but they basically follow the same sort of textbook strategy. Maybe 2 or 3% upside on a rolling monthly basis, and then and that typically, because you're giving up that much upside, will generate a good amount of yield, and so you're seeing these distribution yields of 5, 6, 7, 8%. That we found typically underperform. So even back in 2016, we were looking at the market and our performance, and we found that typically underperformed the underlying investment. So you are always better off not paying the management fees, not collecting the juicy distributions, and from a total return perspective, so taking on lower amounts of income, you always surpass that strategy, and so you were better off just buying the underlying. And so at that point in 2016, we were just that doesn't seem to work. I'd say one of the things that really unlocked a whole area for us across many of our funds was not focusing on where everyone was, which was on the call side, but focusing on the put side. And we're not talking about, when people think about puts, they're like, oh, that's insurance. Puts are there to buy protection. But for every contract, there is a buyer and a seller. And so if people are buying insurance, who are they buying insurance from? How much are they paying? What are these premiums? And how much deductible are they willing to give to the insurance company? And for us, that was a major unlock, because that strategy is basically premised on, I will say, owner fear or owner fear mitigation. So I own my house, I own my car. I'm worried about a flood or a fire. So to make myself feel better, I pay these I pay these premiums. It's no different for an asset like, Apple or Microsoft or JP Morgan. People are willing to, or their entire portfolio are willing to pay this insurance. And this insurance is quite, the best word I could say is yieldy. And so in our dividend growth strategies, we were looking at picking up, again, through a cycle on average, a mid-teens yield. Now, the way it works in ETFs and mutual funds is you have to back it with cash. So think of this as the cash that would have been sitting around waiting for some market dislocation, or think of it as the cash you were sitting, just because you wanted to keep a buffer at the bank account. And so if I were to tell you, Pierre, you could earn a mid-teens yield on your cash, you'd say, yes, sign me up. That's what we want.
Yeah.
So that we've been running this put strategy, since I think, we started it in one fund in 2017. It's across 11 funds plus the 2 ETFs that I manage. And that's roughly about 2 to 3% of the cash. It's just earning this mid-teens yield. Through this crisis, it's been, multiples of that. But again, I think on the long term, it'd be mid-teens. So I'd say that was the one unlock. That ask, when we wanted to get into the ETF space, was, hey, there's all these covered call strategies. Can we get our share of wallet? And so my response was, I'll build you a strategy, but I don't want to replicate what's out there. Because again, it goes back to people have a challenge for income, but they're seeking the wrong product because nothing changed. They still underperform on a total return basis. The big unlock for us, Pierre, was to look at everything as sort of one, dynamic moving body, which is actively pick stocks and then actively rate calls.
Right.
So I can't tell you the pushback I got because it was very different than what was out there. So I said, I didn't want a rolling monthly schedule. And they said, are you sure? And that's what everyone does. Like, let's talk to the dealers. Everybody knows that you're rolling on a monthly. Well, we could roll weekly, bi-weekly, monthly. We just unlocked that part. And then the other big takeaway for us was, let's try to give ourselves as much space above. So not this 2 to 3%. Let's treat companies the way they should be treated, which is differently. You would treat Amazon differently than you would treat, a company like Shopify, that you would treat, Nextera, utility.
Right.
And so you would give yourself different headspace above when you rate these contracts. And then lastly, all these systematic strategies have to rate the contract. One thing that was a bit shocking for people was we may not rate the contract if we don't think that we're getting paid to rate that contract. So we would actually, take less income over the short term, rather than put us in a situation where we rate this contract, doesn't pay us much, and then the stock goes through our level. The last thing I'll say, and I'm sure I know I've spoken for quite a bit. I know you probably the questions are building up. But the last thing I'd say, the other big unlock that we did here that was different than I think many of the different strategies was for an income producing product, we said we were going to own stocks that don't pay a dividend.
That's one of the more innovative things about your strategy. It's very unique. It's on one side, you've got your handpicked dividend payers. And on the other side, you've added this element of growth in these non-dividend paying stocks. When you add that extra layer on top, when you stack the buy right strategy on top, you're actually harvesting income from the growth in your strategy. I guess one point I wanted to bring up was the point you made about the systematic strategies being obliged to write the calls or write the puts, whereas you would have the discretion to decide whether or not to do that. You can be like Casey at bat, right? You don't have to swing for every ball. That's one of my favorite analogies, by the way, from Buffett, which is that, just because someone throws a ball at you doesn't mean you have to swing for it. So let's divide the two segments. Let's first talk about dividends. And what are you looking for in particular in the dividend sleeve of your strategy? What kind of companies are you looking for? There's the stalwart dividend payers. Maybe I'm not sure how that forms a baseline for your portfolio. And then there's the growers.
Sure. So we'll break it, down the stock selection. And one thing I'd say a big unlock for me was, not following, a lot of times it's like growth versus income, and then we bucket stocks. And so for me and my style, it's looking at secular growth trends. And that could be, before COVID, it was travel. Travel was an amazing secular growth trend. It was every year more and more people wanted to travel. It could be on-premise IT infrastructure moving to the cloud. It could be payments, as simple as cash going to credit cards and debit, following that trend. It could be health and wellness trends. And so I like to look at things that have these sort of multi-year horizons, and they keep sort of a nice sort of line that goes from the bottom left of the chart to the top right.
Yeah.
And then looking for stocks that then, can, I call them sort of forces, but that, are the best forces to ride in order to take advantage of that. So in the case of travel, it could be, Airbus, Boeing before all of its problems. It could have been an online travel agency. It could be a hotel, but you look along the value chain and you say, okay, which are, what are these companies? Are they good operators? And, will they, benefit the most from these secular trends? And in some cases, we run a global fund. The best person we find, might reside in the UK, might be in Spain, might be in Japan, might be in the US. And that's sort of how we land on our sort of global allocation. And then whether they pay a dividend or not. Ideally, we want companies, we'd like to be around the same yield as the index. But that's sort of how we do our styles, stock selection. And all the same, quality rules for us apply. We want them to grow their free cash flow. They have to have, quality management. They need to, have an avenue for growth. And they have to have good balance sheets. So that would sort of drive for us. And I'd say our bread and butter for TD Asset Management, it would apply for these two ETFs. And when it comes to dividends, we like dividend growers. So
Right.
again, these are companies that have confidence that they can keep because of they're growing in new markets, new products, new services that they can repeatedly and consistently grow their dividend. That sends off positive signals that the business strategy is working, that the management team is cohesive, and understands the direction in which they're growing into.
Now, what about the, let's talk about the growth side. How do you go about picking the businesses that you're taking stakes in that side?
Right. And so again, we're trying to look at them in one bucket, which is follow the secular trends. So let's, walk through some examples. So, we've been,
These are the non-dividend payers
Yeah.
too. I just to clarify. Yeah.
Absolutely. So, we can look at, let's say we're looking at the cloud movements, the cloud or e-commerce. You could think of a company like Amazon would definitely be your poster child. So a company that has compounded quite nicely from a price perspective, but doesn't pay a dividend, wouldn't be looking to pay a dividend. We see some strategies that will try to slip in Amazon into their funds and say maybe one day they'll pay a dividend. We've seen that from other income products. But I never wanted to apologize for owning a great company. And that's why you'll see later on when we talk about the calls that we can create sort of a synthetic income stream on top of a company like Amazon. Or it might be, in payments or in financial tech companies. We like a company like JP Morgan, but why should that also stop us from owning a company like Square, which is
Right.
also, slowly building a digital bank, piece by piece. So for us, it was at the core of the portfolio. Why should we let that sort of, I have to have an income bucket, I have to have a growth bucket, stop me from owning quality franchises? And then, I'd say for the most part, we're allowed up to, 30% non-dividend payers. But, the bulk of the portfolio are companies that are paying a dividend, growing a dividend. To give you a perspective on how much they're growing, even year to date, the companies that we own, are growing their dividend, 10 to 12%. So, again, think about inflation running at 4 to 5. Our companies are paying us these checks, and these checks have grown, 10 to 12%. And that's just, again, from the income side. And so, again, for us, the big unlock is not to, think about companies as this is a growth company, this is an income company. Let's just look at secular trends and then build the best portfolios that can take advantage of these trends.
It makes the overall strategy definitely more compelling. Dividends on their own might not be so enticing. When you layer in the growth element of your strategy, sometimes investors might look at a strategy and say, well, how come this strategy doesn't own these other companies? And then, the answer to that is that they're not allowed to. It's not in their mandate. So that's what you're referring to when you say unlock. You've got this opportunity to participate in some truly great secular growth names like Square, like Amazon, long term, and then not do that at the cost of not receiving dividends, because now you've layered in this other strategy on top of that, which allows you to harvest income from stocks that aren't paying any income. I think that's the part where, I mentioned, known unknowns. I think my sense is that advisors have a preconceived notion, perhaps that, stems from, getting on the internet, doing some reading about buy right. Personally, I went looking at what was available in terms of intelligence on buy right strategies, and what I found wasn't compelling. The systematic buy right, when you're just doing things, in a machine-like way, you get machine-like results. Everything sort of flattens out and averages.
I don't think there's any malintent on the part of a manufacturer who does a buy right index. That said, I
agree.
think there's some reputational risk to doing so. I mean, I'll put my tinfoil hat on for a moment. There's a number of different ways you can do it, right? So you can write on half the portfolio, maybe half the portfolio you write calls on, and the other half you let go free. You can write on 2/3, 40%, 3/4. So everybody out there who's employing that strategy and offering that in the marketplace makes a decision in their rule set. How much do we want to write on? That's number one. Number two then is like, where do we write? Do we write at the money? Because then it's almost certain we'd be called away and we're limiting our upside. That's where more yield is though. Do you write 2% out of the money? Your batting average is still going to look pretty poor that way. Do you write 5% out? Do you write 10 out? There's no premiums to earn if you write too far out of the money, if you're only going out 30 days. And that's the third piece is, the de facto standard seems to be 30 days, 4 weeks at a time these days. But do we set a rule, do we include one of the rules to be, we write 7-week calls? I don't know, whatever. The trouble with it is you get this set of rules, how much we write on, what portion of the account we write on, how far out of the money do we write, and what kind of time value do we want to try to earn through this strategy? And if you get 5 different providers, 5 different manufacturers, each with a slightly different set of rules, the fact of the matter is this: there is one winner and there is 4 losers, right? There's reputational risk to doing a systematic covered call, because you can do all of your research and all of your homework and yet forward looking, COVID, right? The game might change and you might not want to be writing calls on a systematic basis through summer of 2020 when you had this tremendous snapback. So, the tinfoil hat, the conspiracy theory sort of part of this is you don't see any, or you see very, very few systematic covered call ETFs being launched new at this point, because there's more downside than upside to a manufacturer doing that. They might get lucky, or despite their best efforts, they might end up as the 5th of 5 providers in a category. So, being flexible, being active, I think is really the name of the game. And in imitation is the sincerest form of flattery kind of camp. Now we're starting to get providers who are looking at some of the elements of our strategy and trying to chart that path instead.
When advisors are looking for, third-party intelligence on writing puts and calls as an income strategy, they're finding that the majority of the intelligence that's available is not properly informing them, and therefore they're getting a misconstrued impression of how it can work, how you're actually applying a pinpointed strategy to each of these put writing or call writing decisions.
So there's a couple of different avenues to sort of jump off. I can tell you kind of, and we had an idea, and then we come to market. One of the first things I got asked from, let's say, your advisor is, that's interesting. What's your back test? And when you're applying active stock selection, active call writing, the ability to not write the put writing, and you do it in one holistic package, I was like, there is no back test. because how can you go back in the past and say I would not have written that contract, or I would have,
Yeah.
it's basically cherry picking. And so I'd say that was the first pushback, which was novel. I feel more comfortable with a back test, and that goes back to smart beta, low fall, all these
Right.
systematic, even the covered call. Whether it's good or not, or you agree with it, it has its challenges. It's different parts of the market, it works better. You could always fall back and say, why'd you buy it? Well, this back test told me it works out. It just didn't work in this environment, or it worked in this environment. And so that was, I'd say, some of the answers were novel. Come back to me in 1 year, come back to me in 2 years, or the standard industry line, come back to me in 3 years. So some of it was sort of pushing us off, and then I'd say, watch us, like put us on your watch list, watch us. The other
I think the problem with rules-based investing is not the idea itself, but often it's the rules. Right?
well,
It's
the rules get people comfort, because
Yeah.
again, it goes back to what Trevor was saying. None of these products have any malice. If anything, the systematic coverage call strategy is quite elegant in that it's completely transparent.
Yeah.
Everybody, whether it's the dealer, the market makers, the holders, the advisors, everything that's going on, which is also one of its flaws.
Yeah.
But from a product perspective, could you ask for anything more? You want transparency. That, again, I'd say from that perspective, it solves, that comfort that, I sold my clients a product. I know exactly what it's doing. Again, may not be efficient, solve all the problems, but I know I could explain it to my client. I'd say the other pushback that we got, or again, it's, we're not new to, this isn't an emerging space for people who are, it's a land grab. We're coming into a space that, has entrenched ideas about covered call strategies, and there's already parked a lot of money. Again, we talked about 20 or 30 billion in assets under management in these strategies. And so for us to come and say,
That's in Canada, right?
Yeah.
and that's just in Canada, right?
Yeah.
And then for us to come and say, oh, that's not a really great product from a total, like, if you've ever looked at it from a total return perspective, that's not a very good strategy. And Pierre, I can tell you, I've been in a room, I had good energy with an advisor. And as soon as I said, that's not a great product, the energy level just dropped. Because he owned it and he had his clients in it. And again, he was like, okay, but it's okay, right? It's transparent. But again, it's,
Well, we get very, making decisions is difficult, isn't it? I mean, it's not, there's a lot of energy required, and there's a lot of commitment required when you make a decision about having something on your shelf that you're going to recommend actively to your clients. I think, we get vested emotionally in these things. So I'm not surprised to hear that anecdote, which is that, his face dropped when you said it's not really a good product. But I'd rather hear that from someone like you than from, the average investor.
Or a client.
Coming from you, you're objectively looking at it and saying it could be better. It could be much better.
and I'd say, I'd say the last challenging bit that we found, was, I'd say, we came to market in 2019. I'd been working on the idea for, almost a year. We come to market in 2019. Arguably, this has been there's a major, stock market bull run from, we'll call it, February or March 2009. And that there's this strong rules, or I'd say maybe even a heuristic or, rule of thumb when it comes to covered call strategies, which is, they don't work in a full market,
Right.
Or we'll call it a very fast rising market.
Yeah, exactly. That was one of the things that kept coming up in sort of my sort of background research on covered call writing and buy right strategies, was that you don't want to own something like this in a strong market, in a bull market, because you're giving away some of your upside for it.
Exactly.
Sorry.
And then it's good in a sideways market, and it's great in a falling market. But Pierre, I'm going to put you on the spot. We have a major bull market right now, since March 23rd last year. So are we near the top? Are you going to switch from your uncovered strategy to your covered strategy? I think it's a lot to ask, even for myself. I don't call tops and bottoms. I look for my secular trends to make sure those trends haven't broken, or the companies, those forces, don't misdirect
Yeah.
themselves from the strategy. But for me to say, oh, you got to switch from uncovered to cover because the market's going to turn, to then put all that pressure on the advisor, I think is quite a big challenge, especially because, again, there's so many different needs that they're trying to solve for their client. To just say,
Yeah.
okay, I gotta sell one product, gotta buy this other product. That's a big tactical call that no one wants to make, because if you're wrong, it doesn't look good.
Right.
What we were, this project, these products, basically what we were saying is, because we're going to do the active element on the call strategy, and we're focused on total return, our premise is that we're going to beat our benchmark, and that, we can outperform in a fast rising market. And so, we can look at the history, so TGED, the global ETF, that was the one we incepted in spring 2019. The market was already on a run,
Right.
dealing with, we forget now, we had a US-China trade war, but we added value, through that
Yeah.
run. And then we added value on the market plunge during COVID. What I'm really proud of is that, that rip and I think we can call it a rip from March
Right.
the 3rd,
Technical
even to
term.
today. We're talking like 45-degree angle. We continue to add value. And what we noticed is that some of these newer strategies that, that employ an active element or the systematic could not keep up, because, again, we don't know exactly their methodologies when they say active. I just assume because of their distribution yields, they have to, they don't give themselves much upside, or it is really challenging to say, I won't read that call. Again, you got to make that decision. That, I think for us, that separated us from the pack.
Yeah.
And that unknown that I think everyone should know now is, you can rank covered calls and you can outperform the market. And you don't need this pressure of, I'm going to be uncovered now because I know exactly that the market's going to go up. Oh, I'm going to cover now because I know the market's going sideways or down. The last thing, on what we saw, the speed at which the market peaked and the market plunged was around the same time that these systematic strategies rolled their covered calls.
Right.
And so that, that premise that these strategies outperform in the down market in this specific situation with COVID didn't apply. So, Feb 19th was the market peak.
Yeah.
That's roughly around the third Friday of the month when all these strategies roll over. Again, everyone knows this. The VIX, so let's say that's our measure for implied volatility, which is going to drive the premiums that you get from writing these calls, was, I'd say sub 20.
Right.
At its peak, it was like 80 or 90. So we're talking about, a major, spike in volatility, which means a major spike in premiums.
Yeah. That was the beginning of March.
And so, so Feb
Right?
19th,
Beginning of March 2020.
right, it's when
Yeah.
we get the spike. And then, the bottom of the market's March 23rd, which again would
Right.
roughly coincide with that third Friday. For us, it was obviously, traumatizing, one from just a, personal safety and friends and family. And then, the other challenging part was, the stocks that we owned. I mean, all of a sudden, doors are closing. You're wondering if, any of the businesses you own can survive. I would say from an option premium perspective, it was Christmas every day, because we were able to constantly reprice our options.
Yeah.
So, we might have sold it for 50 cents. It's worth a penny because the stock falls. We buy it back. We write it again. Stuff that, when it might have been 2 weeks out or 3 weeks out, we brought it in. So we're constantly repricing as much as we can to go up the curve and then down the curve. And again, if you followed a systematic strategy, you kind of were locked in.
Right.
And then, once you started to say, okay, I'm going to catch up, that's when the market pivoted. And if you're putting in your 2%, upside, that doesn't work from March 23rd to today. The market just kept going, and you would have just kept getting stopped out, and yet you'd have to keep buying back, at higher and higher prices.
It's very interesting just to, again, delineate between the fact that a systematic approach wouldn't be able to make those daily decisions. A lot of algorithms were delayed because they're waiting for the turn of a signal. Like a lot of the things we've talked about today are due to the biases that people have about so many different moving parts in the market. And a lot of those biases are preventing them from investigating new ideas and taking a deep dive into something like this, like what we're talking about today, that's really profound in its, in its effectiveness. So let's recap what we've talked about. We've got the dividend sleeve, right?
And
And
still, I'm going to push back here and be like,
Yeah.
there's no sleeves, right? Like we look at it holistically.
Okay, good.
So we got we got the we'll call it the core of the portfolio. So that's our dividend growers, and our we'll call it the non-dividend payers, but we'll call it secular growers. And that's one layer that we again, if we think about it as a cake, that's one layer that we put together, and we're trying to seek out a market level of dividend yield, and that would be the base layer. And then on top of that, then we would apply the call overlay, and that's just trying to bring in the income. I like to look at it. If we likened it to real estate, I have a bunch of great buildings or multi-units, and now we want to collect rent from them, and that's how I look at the call premiums. I mean, I'm trying to collect rent from all these assets that I own, and again, one of the unlocks that we found was you could have a company that pays you a dividend, and we could write, a call on it, and the net yield, we might achieve that even better by writing a call on Amazon and giving ourselves 8% upside for the week, or 8% upside for 2 weeks. And that's, or the a similar contract on Square, might yield better than owning JP Morgan, and then even layering another call on top of it. And so we look at the calls, and that's another, sleeve of income. And then, then we'll look at our puts, and we'll think about how much cash we want to hold. And, being an active manager, and I have a team of analysts, we know what stocks we want to add, or either add to the portfolio or increase the weights in our portfolio. And that's where the put contracts are on. And, I've done the work, and my team's done the work, and we're happily to take assets off people's hands. So it might be 5% out of the money. It might be 10% out of the money. So we're talking about below the market price.
Right.
And again, people are giving us these yields. And I think, again, long-term would be mid-teens. In this environment, it's even juicier. So we're seeing multiples of those yields. And then holistically, all that together, we think that's about a 4% yield in TGD, about a 3+% yield in TRED. And to go back to what we said about the original, the problem statement that we're focusing on is obviously people's yields have collapsed. And they either need to double their assets overnight, or they need to move up a risk curve. With our strategies, I mean, people are going to recognize the stocks that we own. So it's not like they're moving up the risk curve. They're owning quality franchises in secular growing areas. And there's a growth element in the sense that even though they pay dividends, they're still growth companies. And we have companies that, they're better off reinvesting in their business and growing themselves as well. So that solves, I think, the growth element and some of the income. But again, dividend yield today is not enough. And that's where, we want to enhance it. That's the calls and the puts, and, 4% plus, I think puts you in a pretty comfortable range for most investors. And again, our style, because it's growth, income, total return, doesn't just apply to, people in their 50s and 60s or 70s. I think it applies for, a wide range of people, even in
it's more
30s and
universal.
40s. Exactly. So then it's solving a lot of things and trying to do it in an elegant way, but in sort of one product.
We're upping the sophistication of global equities. This isn't something that I would suggest investors do on their own. If you were to employ covered call writing strategy as an individual tax filer in Canada, the CRA may have something to say about that, and all of a sudden it's income, right?
Yeah.
Advisors, your most precious commodity is time. It's client-facing time, really. And so it is possible that an advisor could employ something like this herself or himself. But this is, I'm biased for saying so, but this is something we pretty firmly believe you should delegate to a provider, to a manufacturer like TD Asset Management, because every contract you write is, one less client interaction, so to speak. Here in Ontario, dealing with advisors and portfolio managers for, a decade and a half, I can count on one hand the number of investment professionals who do this as part of their value proposition, because it's just so labor intensive. There's something really, really elegantly simple about giving that responsibility to us via the ETFs we have on offer.
Yeah. And on top of that, it's in the ETF wrapper. So 70% dividend stocks, 30% non-dividend, or up to 30%.
Yeah,
up to 30%.
I'd say, we're probably about half that. We're probably around 15%.
Okay.
But again, it's not that that's prescriptive. It's just, we have the ability. Again, everything goes back.
Yeah, you have cash as well, right?
Right.
That's
but,
right.
Everything that we found is the more restrictive, the more rules, the more you hold yourself back. And most people are like, I want more rules. But in terms of total return performance, the less, the more ability that I can, buy this, the companies that we want to buy into. Again, not be stuck that it has to have a dividend or not a dividend or a targeted yield.
Right.
Or, okay, fine, let's make it only 10% non-dividend payers. We'll give you a little, but, we want to still say it's income. And we said we can generate synthetic yields better than dividend payers. So, why stop ourselves? Now, again, it's an income product. So, we say 70-30, but I have that ability that, again, depending on the market, to take it up there or to I don't have to own a dividend payer. It just, again, it's that flexibility allows us to, get the creative juices going. And again, we're maximalists too, just not maximizing yield, we're maximizing the total return.
All three.
Think of the flip side
total
too,
return,
right? If there's a dividend paying company that suspends their dividend as part of our portfolio, then Ben and team have a decision to make. It's not automatically going to be forced out. If a company chooses to suspend a dividend due to COVID, as opposed to fundamentals, we're not forced to exercise ourselves of that business, right? And to Ben's point, we can continue to make our own dividend, so to speak, if you will, on the call side of it.
So that was a big factor. That I don't know how big of a factor that was, but for you, but I'm guessing it was, given that during COVID dividends were cut. How did that affect your strategy?
So I'd say, again, for people that depend on dividends, that was quite shocking.
Yeah.
And in some cases, you can't blame the company. When they're laying off their employees, when the business is, ceasing because we effectively had to shut it down. You want a viable business. And so in some cases, you would understand it. There are many companies that we own that sustained their dividend, even grew their dividend last year in probably, the worst environment of our careers. So not to say that, all companies, some companies were severely impacted. Some companies, we're still able to ride it through. And a lot of it is because we focus on on balance sheets. But I'd say for the average investor that, that's a challenge if you were depending. Even companies like AT&T, kind of cut their dividend as well. A lot of people depend on that yield that comes from that telco. I'd say the one thing that really, and so going back to your original question, and again, that's where the calls can come in. And I remember I said it was almost like Christmas Day. Again, the implied volatility, so the uncertainty of the path of where that stock could travel on a week or on a 2-week or a 3-week basis was so unknown because none of us had ever experienced this before. That's what really fueled those premiums. And so we more than made up for, our dividend income, compressing on the call side. I'll probably never, hopefully I'll never see that again in my career. But from,
Yeah.
a harvest and yield perspective, one of the, amazing moments I never experienced. So
But if you weren't running this combined strategy, you wouldn't have been able to do that,
exactly.
right?
So
Yeah.
there are many,
Yeah.
I think it's like the aristocrats where they have to have, 25 years of dividend growth. That's amazing. You can find a
Yeah.
company that can do that. They miss, one dividend payment and they might be booted, 3 years or 5 years. I think the rules have been massaged over time in order to let
Right.
people back in. The one thing I'd say that, is, completely different and something, we never sort of faced before was, it's a healthcare crisis. It's a social crisis. There were companies, again, we had done our research. They had ample balance sheet, that still cut their dividend, because of social pressures. Again, because of COVID, they didn't want to be, seen on the front page of newspapers enriching shareholders with either buybacks or dividends. And so they even cut it. So for us, I'd say for me and my team, that was a big surprise in the sense that, we pride ourselves on, getting out of companies that, we think might
Yeah.
cut their dividend. And here, we did our homework, and this new element about, social pressures, forced them to cut their dividend or suspend it. Now, coming out of the crisis, many companies are in great shape and they're generating, free cash flow, the notional levels of free cash flow that we hadn't seen before, because in many ways, COVID caused them to become more efficient and we've seen margin expansion. It's a bit bifurcated. Some companies have been able to bring back their dividends, and not face any sort of newspaper headline pressure.
Right.
And we've seen that, 5% increase, a 10% increase. And there's some elements or some companies that might be more in the eye of, let's say, the general person, that if they were to institute a dividend, or increase their dividend or do big buybacks. So, let's say the major pharmaceutical companies that are, supplying, the vaccine are, generating a lot of cash flow and free cash flow.
Mhm.
They are not able to return any of that to shareholders, because you better believe that that would be on the front page that, they're
Yeah.
enriching themselves on this healthcare crisis. Some companies, they've been given a pass, and other companies I think have been held back or holding themselves back, maybe into
Yeah.
2022, so that they won't get this sort of headline, front page that, the shareholders are being rewarded while either employees or their clients, are still being impacted
Yeah.
by the virus.
Wow. That was an angle that those are some of the unintended consequences of ESG, right? Trevor, you said there are advisors who do this themselves, who try to do things like buy right themselves, and it's not very efficient from a tax point of view. Within the ETF wrapper, it's very efficient, number one. And number two, option writing income, the option yield is also treated as capital gain,
Yeah, that's correct.
right? It's not,
Yep.
it's very tax efficient income.
It's a little in the
So-
weeds, but think of sort of two layers of tax with regards to ETFs is what you do as the investor. Did you buy it here and sell it there? And then there's what we do
Yeah.
as the ETF provider, right? So if we have turnover in the portfolio, yes, there could be capital gains, of course, and you would pay taxes in the year that was realized, and then you'd add that to your ACB, right? So with regards to call writing, that is on the capital side of the account. So that would be distributed to investors as capital gains when the year is up. Put writing is a little different. So put writing is on the income account. So if we write a put where we don't own the security, but we're writing it, cash secured put, that could end up being income to an investor.
Right.
But, then I would say recall that all ETF companies, TDAM included, we get to choose where we take our fees from. So our management fee, we will always take our management fee from the most tax inefficient portion of the income. right?
Right.
So if we have a chance to, we will take it out of foreign income or put income, and we'll leave the eligible dividends, if any, or the capital gains distributions for the investors at year end. So we're trying to make this ETF as tax efficient as possible, in addition to delivering, a good outcome, a gross of taxes. Net of taxes, we want this to be really efficient and really of benefit to investors as well, for sure.
Yeah. Thanks for clarifying that, Trevor. That's nifty. When you combine the dividend income and the growth and the option income, that makes for a very nice total return, total income.
Yeah, don't take
Uh,
our word for it, right? But I happen to think it's a killer app.
yeah.
The thing about back tests is I've never met a back test I didn't love, as the saying goes, right? So we don't have a back test, but we have almost 30 months of history. We have live data at this point, and this is an ETF whose assets have doubled year to date. So, there's more interest. We're gaining more traction. And I think
Yeah.
at the very least, we'd want people to put us on the short list or on the watch list. But let's have a conversation as well, really. Let's take it off the podcast today and get to the finer points of, whether or not this would be a fit inside of an advisor's model or portfolio.
Thank you very much, gentlemen. That was very, very interesting. I think, it's something that investors and advisors alike should be looking at more closely. How can advisors find you, Trevor?
So I guess for the purposes of the audience today, I'm one of 3 ETF specialists in Canada here at TD Asset Management. So there's one out west, colleague of mine, Greg Crozin. There's Jonathan Needham, who covers Eastern Canada and has some national accounts responsibilities. And we all interface with advisors in sort of the IROC space via our broker-dealer team. So if you're familiar with who your TDAM wholesaler and insider are on the fund side, we interface, we partner with them. So we float around
Okay.
a little bit is the fun part, but the main way you can have an ETF discussion with us is via your TDAM sales team that you might already be using for our mutual funds, for example. And then, we can have both conversations, which is great.
So any final takeaways from both of you?
I'd say from my perspective, Pierre, I appreciate the platform and interest. I wish, our strategy had that, one line, this is, you have this problem, this is the answer. I think, we had quite a lengthy discussion. There's many layers and there's all this sophistication that we're trying to do one product. So I appreciate the opportunity to, again, we're trying to solve not just an income problem, but a growth problem because of how low yields are. And we think, our 2 ETFs, EGED and TRED, solve many problems for the advisor and for their clients in order to meet those needs without having to, go and do something challenging from a risk perspective. And so, again, it's quality franchises and secular growing industries. And it's about dividends and call option premiums and put premiums, but in a way that the industry never sort of, thought of, because, we like to think about things in sort of rules and buckets. And so I encourage people, if our discussion, piqued their interest to reach out, and we're happy to, again, walk you through exactly what we're trying to do.
Trevor?
Yeah, pretty much the same thing. I think I'd be remiss if I didn't say that TD has, let's say, afforded our competitors a head start. There's some ETF companies that have been around for 10 years, for 20 years. And we're a little newer than, maybe some of the more established players. But to that end, it means we must innovate. We must try harder, to borrow from Avis, right? So I think a common thread to our passive ETFs, our quant ETFs, our sector ETFs, our active ETFs, is the innovation that has taken place. We look at the landscape. We try to evaluate what the pros and cons are really of some of the legacy products that are out there. And we're really trying to build better ETFs for our advisor clients, for their investors alike. And I think, in this business, dollars are votes, right? We have the votes of confidence. We have this really incredible asset gathering momentum behind us, which, knock on wood, tells us we're doing something right. So we're going to continue to launch product that we think is timely, that innovates the space, that tries to improve on that, which is already out there. And with regards to active, to borrow the Gretzky phrase, we're skating where the puck will be. If you look at the ETF industry, the fastest growing segment is the active ETF, and TGED and TUED are really the flagships on offer for the active side. So, appreciate the time to talk to it, Pierre. Ben, good to see you again. And, let's do it again soon.
Thank you. And so one last question for both of you. Would you rather be the worst player on the best team or the best player on the worst team?
I'm quite a basketball fanatic. I think it depends on your career. I think we've seen with certain basketball players, be it Damian Lillard or Steph Curry, being the best player on maybe not the best college team gets you in the pros. But what we've all seen from The Last Dance is being the worst player on the Chicago Bulls got you 6 rings. So I guess my answer is it depends.
Yeah.
I don't want to come out and say that I enjoy being the stupidest guy in the room. But I do love being at a shop that has just such intellectual capital behind it. And so, having the worst house in the best neighborhood, or, being the worst player on the best team, it is, to me, really what it's all about, is the opportunity to learn and grow from peers. You don't get that if you're the best player on the worst team or something like that. So I'm going to go with Ben on that one.
Awesome, guys. Thank you so much. It's been a real pleasure talking to you, and it's been very enlightening.
Thanks, Pierre.
Thanks, Pierre.